Okay, dear students, let's start a revision class and you can say practice also. On IAS 33, we'll be revising IAS 33 through questions, and all of these questions are from your study hub. So I've also disclosed the source, that is study hub, IAS 33 EPS. Let's start. Question number 1 says, how much new finance was raised by right issue? Obviously, we know that right issue, whenever company makes a right issue, company raises the finance. Now, this time they are asking a very different question when it comes to IAS 33. They're not asking weighted average share in this question. They're not asking theoretical X-right price. They're in fact asking us how much company has raised the finance by issuing right shares. Okay. Let's see. For that, I just need to know two things. One, right issue price, and second, number of rights. If you can calculate how many total number of right shares company has issued, multiply by the right issue price, this will give you how much finance company has raised. A company currently is having 10 million shares. These are 10 million shares, $1 par value, in issue with a market price is $3 per share. The company wishes to raise new funds using 1-for-4 right issue. Right now, they have got 10 million shares. Company wants to make a right issue 1-for-4. Now listen, 1-for-4. So how many total right shares company has issued? Can I say 2.5 million? These are the total number of rights. Now we just need to know the right issue price. Right issue price. If we know what is right issue price, then multiply by the right shares issued, which are 2.5 million, multiply by right issue price. It will give us exactly how much finance company has raised. Okay. The theoretical X right price is 2.8. Theoretical X right price means share price after the right issue. Theoretical X right price means share price after the right issue. Okay. Now, first of all, you need to know the format. How do we calculate theoretical X right price? That will help us to find out the right issue price. Shares, we're discussing question 1. Values, then we have got total value. Shares, values, and total value. Four shares, one right. Right now, the market price is $3. That is share price before the right. We don't know right issue price, which actually we want to know. 12. Okay. Examiner has given us the TRP, theoretical X right price. Theoretical X right price is 2.8, which means that 5 multiplied by 2.8. This will give us the value of total shares are 14. Now it's very simple to calculate the right issue price. Total value is 14 and the value of shares before right is 12, which means that 14 minus 12 will give us right issue price is 2. If the right issue price is 2, total number of rights we have already calculated. Companies is already having 10 million shares. 1/4 means total number of rights, they are 2.5 million. And right issue price is $2. It means how much finance company has raised? 5 million. This is finance raise. I would say an excellent question, a very different as compared to what normally comes in IAS 33. They have asked us to give us finance raise. Of course, little bit backward working was involved. Charlie. C is the answer. Now come here. In accordance with IAS 33, earning per share, what is Vexama's basic earning per share for the year ended 30 September X3. Basic EPS, okay? In the year ended 30th September X3, Vexam reported retained profit 4.8 million. Retained profit. While calculating EPS, we need profit after tax. Paying preference dividend 2 lakh. Retained profit means, of course, preference dividend is already deducted. And dividend 800,000 to the holder of ordinary shares. They have, while reaching at 4.8 million, they have already deducted the preference dividend, which is okay. They have already deducted the ordinary dividend as well. Fine. On October X2, Vexam had 3 million shares in issue on 1st April X3. The company had made a bonus issue, one for every 3. First of all, in case of bonus, you should be able to calculate bonus fraction. How do we calculate bonus fraction? Shares after bonus divided by shares before bonus. 1 share for every 3 means before the bonus there are 3 shares. After bonus they will become 4 because company is issuing 1 bonus against 3 shares. So the bonus fraction will be 4 upon 3. Okay. Now, if you look at the formula of EPS, profit after tax, actually EPS is equal to profit after tax, we deduct preference dividend. We do deduct NCI non-controlling interest if I'm calculating EPS for the group. Divide by weighted average ordinary shares. Now examiner has given us the retained profit. Retained profit is 4.8 million. Okay. From profit after tax, I do deduct preference dividend. But while calculating EPS, we do not deduct dividend to the ordinary shareholders. Repeat. We only deduct dividend for preference shareholders. We do not deduct dividend for ordinary shareholders. That is why the dividend which was paid to the ordinary shareholders, only that will be added back. So 4.8 million plus the dividend which is paid to the ordinary shareholders, I'll add back this. There's no need to add back preference dividend because if you add back preference dividend, you will get profit after tax and then again you have to deduct the preference dividend. Why? While calculating EPS, logically we take profit after tax minus preference dividend. So this 5.6 is actually representing profit after tax minus preference dividend. Now simply divided by weighted average ordinary shares. Okay. Now before the bonus, how many shares company is having? 3 million shares. Before the bonus, we have got 3 million shares. Just do one thing. Very easily we can calculate weighted average ordinary shares. We'll take 3 million shares. Simply multiply by the bonus fraction, 4 upon 3. So straightforward weighted average number of shares will be 4 million. Another way of getting this 4 million is, in case of bonus, simply we assume that bonus was issued at the start of the accounting period. So obviously total number of bonus, they are 1 million. Why they are 1 million? Because company has issued 1 share as bonus against 3. So before the bonus, there are 3 million shares. So definitely in the form of bonus, company has issued 1 million. So the total number of shares will become 4. Straightforward weighted average ordinary shares. 5.6 divided by 4. Students, I'm getting 1.4. Here the main concept, the main point was that examiner did not give us directly profit after tax. Examiner has given us the retained profit. And from this retained profit, it is categorically mentioned in the question that examiner has deducted the preference dividend as well as ordinary dividend. When it comes to preference dividend, we are okay with that. Even if we calculate EPS, we do deduct preference dividend, but we do not deduct dividend to the ordinary shareholders. That is why dividend to the ordinary shareholders we have added back. Question 3 actually starts from here. This relates to the answer of question number 2. That is We say that bonus was issued at the start of the year. Let's see question 3. Reploy has reported profit before financing and income taxes. Here, the term which examiner has used or study hub has used, before financing and income tax, this term actually they have taken from IFRS 18. Due to the, I would say, due to IFRS 18, which has actually replaced IAS 1, your income statement format, it has changed completely. Now, actually, under IFRS 18, we have to follow the format of income statement and we have to make 5 categories. Obviously, you will be studying that. Don't worry at all. Right now, Reploy has reported a profit before financing and income taxes. So this is simply a profit before interest and tax, 7,28,654 for the last financial year. The company's statement of profit and loss represents interest is 45,860 and income tax expenses 1,58,740. The statement of change in equity show an ordinary dividend. Okay. The company issued ordinary share capital. Ordinary share capital is 5 lakh, par value is 1. So number of shares, they are also 5 lakh because ordinary share capital divided by par value will give you number of shares. Required to do simply in accordance with IAS 33. What is Reploy basic EPS? We are just required to calculate Reploy basic EPS. Now, let us first calculate profit after tax. How will you calculate profit after tax? Examiner has given us profit before financing and income taxes. 7,28,654 minus the interest 45,860 minus the tax, which is 1,58,740. 7,28,654 minus 45,860 minus 1,58,740. So 5,24,054. That is profit after tax. We listen, student, carefully. We do not deduct ordinary dividend. We do not deduct the ordinary dividend while calculating EPS. We only deduct dividend to the preference shareholders. So we are not supposed to deduct the 50,000 dividend to ordinary shareholders. Now simply divide by 5 lakh. Share capital is 5 lakh, par value is 1. So 5 lakh divided by 1 will give you 500,000. So straightforward, here comes your EPS. 5,24,054 divided by 5 lakh. Students, I am getting 1.048. If you do not get the exact answer, so always go for the nearest one. Logically, the nearest one is B. Of course, we have calculated 1.048. It is very near to 1.05. Now, in accordance with IAS 33 EPS, what is Valor's basic EPS? Okay. The most recent statement of profit and loss of Valor presented a profit before income tax. So first of all, here comes your profit after tax. 12 lakh 50,000 minus tax, 2,24,000. Because in EPS, we need profit after tax. Examiner has given us the profit before tax. So this is your profit after tax. Halfway through the year, company had issued 40,000 bonus shares, which brought the total number of shares 440. So here comes your EPS. In this 4,40,000 already bonus shares are included. Whenever there's a bonus issue and there's no other issue at all, simply we take bonus. We say that bonus was issued at the start of the year. And straightforward, you will get weighted average shares 4,40,000. Let's see. Students, I'm getting 2.35. Okay, now. Here, examiner is asking us to calculate diluted EPS. Before the calculation of diluted EPS, first of all, you need to know one thing. While calculating diluted EPS, we assume that all the potential ordinary shares they have converted to all the potential ordinary shares they have become ordinary in day one. Number one, diluted EPS is not your actual figure, it's an assumption based value. The assumption is while calculating diluted EPS, we assume that all the potential ordinary shares they become ordinary in day one, and then what will be our EPS? We say it is diluted EPS. The objective of diluted EPS is to show the dark side of the business, just to show the investor that EPS could be reduced to this level. That is diluted EPS. So while calculating diluted EPS, we actually assume that all the potential ordinary shares they have become ordinary. Okay, here examiner has given you the convertible bond. I'm just giving you the idea, and then I want you to at least try. When we will be converting this, when we'll be assuming convertible bonds, they have become ordinary shares. Number one, they will be interest saving, because when convertible bond they will become ordinary shares. So obviously, we will not be paying interest. So when there will be interest saving, due to interest saving, your earnings will increase. So whatever comes in your mind, you have 2 minutes to attempt this. I want everyone to attempt this. Please, you have just 2 minutes. Let's see. Mock has disclosed basic EPS 0.32. This is based on 500,000 ordinary shares in issue for the whole year. EPS examiner has given us 0.32 based on 5 lakh shares. Mock has also $100,000, 8% convertible debt in issue at the year end. The conversion ratio allow the holder to convert their debt into equity on the basis of 5 shares for every $4. Income tax rate is 30%. First of all, whenever your examiner gives you convertible bond, which is obviously a potential ordinary share, whenever the term convertible is used before any instrument, even then after the name of any instrument, the term convertible comes, that is a potential ordinary share. While calculating diluted EPS, we make an assumption that potential ordinary share, they become ordinary in day one. And then whatever the EPS comes, we say it is a diluted EPS if it is less than the basic, okay? Now, in case of convertible bond, first of all, what do? We need existing profit after tax. Then simply we'll add interest saving after tax. Then you will get revised PAT. Whatever the revised PAT comes, that will be used in diluted EPS. Okay, how to calculate existing PAT? Simply EPS is equal to profit after tax divided by weighted average ordinary shares. We do not have any preference dividend in the question. Okay, so this is the formula which examiner has used. Examiner has given us EPS 0.32. Profit after tax we don't know, but examiner is very nice, or study hub is very nice towards you. They are saying 5 lakh ordinary shares being an issue for the whole year. Whole year number of shares, there were 5 lakh. Which means that the 5 lakh becomes your weighted average ordinary shares. I'll multiply both of them, that this will give us profit after tax, existing profit. So 500,000 multiplied by 0.32, I'm getting 1,60,000. Now add interest saving after tax. Mark has 1 lakh $100,000, 8% convertible debt in issue at the year end. Now, student, listen to me carefully. Mark also has $100,000, 8% convertible debt in issue. If examiner gives you two interest rates in case of convertible debt, one, like examiner has given us $100,000, 8% convertible debt. Okay. If in the same question examiner says interest rate on non-convertible debt is 10%. If in the same question, assuming examiner gives you interest rate on non-convertible debt which is 10%, if that is also given to you, then we always use interest rate which relates to the debt which is not convertible. But right now in this question, other than 8%, we do not have any other rate. So that is why I'm using 8%. Otherwise, if examiner gives you two interest rate, one is the interest rate on convertible bond, another is interest rate on non-convertible bond. We will always use the interest rate on non-convertible bond because that is the rate which we use for calculating interest expense. But here we don't have, so I'll be using it 8%. Add interest saving after tax, so 1 lakh into 8%, 1 minus tax rate. Tax rate is 30%, so which means that 1 lakh into 8%, 1 minus 0.3. So 1 lakh into 8% gives us 8,000. 1 minus 0.3 will give us 0.7. I'm getting 5,600. Students, make sure your mic should be closed. It's a request to everyone. Make sure your mic should be closed. So 1,60,000 plus 5,600. I'm getting 1,65,600. This is your revised PAT for diluted EPS. Already ordinary shares we have 5 lakh. Now simply add shares from conversion. Shares from conversion. 800,000 convertible bond. Now let's see the ratio. 5 shares for every $4 of debt. 5 shares. This is dollar, this is $4. 5 ordinary shares against each $4 debt. So simply 1 lakh multiplied by 5 upon 4 gives us 1,25,000 number of shares. Now your weighted average shares will be 6,25,000. Here comes your diluted EPS. 1,65,600 revised earnings divided by, you can say, revised weighted average shares. 1,65,600 divided by 6,25,000. Students, I'm getting 0.26496. 0.26496. Again, if you do not get the exact answer, always go for the nearest one. Can I say A? This is the closest one. Of course, yes. Okay. Now come here. Let's just read this question. All the questions I've taken from Study Hub. Actually, in our FR as well as in other courses, what exact, I would say, source of material we are using? One, we are using Kaplan kit along with the past papers. Of course, all the pre-seen mock, plus we are using Study Hub. So that is more than enough. These sources are more than enough to pass, I would say, any paper with flying colors. So you will get, this is what we are using in all of our papers. At ASA, we are using Kaplan kit along with the past paper, pre-seen mocks, and study hub. Okay. A company makes 2 for 3 right issue at an issue price of $2. This right issue price. Come right price means share price before right. Share price before right issue. So we just need to calculate theoretical X right price means share price after right issue. So simply make a format of 3-column format, which we use we have used so many times in our regular classes. Shares, values, and I would say total value. So company makes 2 for 3 right shares. 2 is the right share, 3 existing. Share price before right is 4, right is 2. Simply multiply 12, 4. We can say 5 shares, total value 16. If 5 shares, they are having total value 16. So what will be the price of 1 share? Let me check. Internet should be very stable, I believe. I hope my voice is very, very clear to everyone. There shouldn't be, I believe, any lag, nothing. Okay, so we can say that 5 shares, they have total value 16. So what will be the share price? What is the price of 1 share? That is TRP, TERP. 16 divided by 5. Oh, 16 divided by 5. I'm getting 3.2. So the theoretical X right price means share price after the right is 3.2. Okay. In accordance with IAS 33, what is Chartwell's basic earnings per share for the year ended 31st March X3 to the nearest cents? This is also very important, students. If examiner is asking to the nearest cents, answer in dollar in the answer box. Okay. But they're saying when you are answering in the answer box, then you'll be using dollars. Okay, we'll use dollars. Chartwell has in issue 1,20,000 equity shares, share capital. Par value is 50 cents. It means 1,20,000 divided by 0.5. So number of issued shares, they are 2,40,000. Again, read it. Chartwell has in issue 1,20,000 equity shares. Bracket says shares of 50 cents each. So the par value is $0.5. So 120 divided by 0.5 will give you 2,40,000 shares and 10,006% preference shares. Now, student, always listen one point. Whenever your examiner gives you preference shares, nothing is mentioned. We always assume given preference shares are irredeemable preference shares. Irredeemable preference shares, they are equity. Second, further nothing is mentioned. We always assume given preference shares, they are cumulative. Cumulative preference, in case of cumulative preference shares, either company declares the dividend or not, you have to calculate the preference dividend and deduct while calculating EPS. Don't forget these assumptions. Nothing is mentioned. We always assume given preference shares are irredeemable plus cumulative. Extract from the financial statement for the year ended X3 are shown below. They are giving us profit before finance and income, interest, I'll deduct, income tax, I will deduct. So this will give us profit after tax. Let's see what is the value of profit after tax. 5,28,934. 5,28,934 minus 6,578 minus 1,25,860. Students, I am getting profit after tax 3 lakh 96,496. Preference dividend ordinary, of course, ordinary we do not deduct. The preference shares are classed as equity instrument, means irredeemable. So the dividend which is given to the irredeemable preference shareholders, that will be deducted, and it is categorically mentioned. Preference shares are classified as equity instrument. So 3,96,496 minus 1,800. I'm getting 3,94,696. And other than 2,40,000 shares, there is no other information. So entire 2,40,000 will take as weighted average ordinary shares. So here comes your basic EPS, I would say. 3,94,696 divided by 240. Students, I'm getting 1.6, then 444. So just 14. So $1.64 is the answer. Because they are saying answer in dollar in the answer box. If it was mentioned answer in cents in the answer box as well, then this 1.64 we would have multiplied this by 100. Then your answer would have been 164 cents. But it is they have mentioned that in the answer box you have to use dollars rather than cents. Okay. Question number 8. In accordance with IAS 33, what is Dale's basic EPS? Now, student, I really want every one of you to attempt this. I'm just giving you 2 minutes, but you should be able to do it. Don't take time more than 2 minutes, please. Okay, now let's try. Student have answered. That's great. In accordance with IAS 33, we are just required to get we are required to calculate EPS. In the year ended 30th November, retained profit of Dale was 3.6405 million. This was after paying dividends as ordinary preference. Again, we have no issue if you have deducted preference dividend, but we do have issue while calculating EPS that you should not be deducting dividend to the ordinary shareholders. So 1.5 million into 0.05. Let me use the calculator. 1.5 million in this. I'm getting 75,000. So simply dividend to the ordinary shareholders will be added back. 3,640,500 plus 75,000. Whatever comes divided by 1.5 million, because other than that, we don't have any other shares. 75,364,500. 1.5 million. So 2.477 again, I think great. Answer given by the student is perfect. 2.48. Question number 9. In accordance with IAS 33, earning budget, what is EPIC's basic EPS? Okay. I'm very surprised to see one thing, that study hub people, they almost did not ask, I would say, a variety of questions on the calculation of weighted average ordinary shares. They have so far, I have not seen. They have completely neglected till here. I don't know. The financial statement of EPIC showed that consolidated retained earnings had increased in the year by 6,89,444. These are again retained earnings. The following items were presented by EPIC in either a statement of profit and loss for the year or in the statement of change in equity. Interest expense, taxation, profit attributable to non-controlling interest, Ordinary dividend, again, you should not have, of course, while calculating EPS, we do not deduct dividend to the ordinary shareholders. They have given us retained earnings. Retained earning is the earning which actually belongs to the parent. So simply we'll take 6,89,424 plus 65,000. Logically, non-controlling interest is already deducted because consolidated retained earning is the retained earning of group, retained earning of the parent. Technically, NCI is already deducted, so further there is no need to deduct NCI. So 6,89,424 plus 65,000. 7,54,424. Okay. Now, ordinary dividend is this. Now they are saying 0.1. This is the par value. So student, very easily I can calculate number of shares. If this is the total dividend, okay, try to understand. $65,000 is the total dividend, and per share, the amount of the dividend is 0.10. So I can easily calculate the total number of shares. 65,000 divided by the dividend per share. 6,50,000 if I'm not wrong. There will be your total number of shares. Students, I'm getting 1.16. Charlie, 1.16. Okay. In accordance, question number 10, in accordance with IAS 33, what is Jubilee's diluted EPS? Okay. Jubilee's reported profit for the period is 1.6 million. It had 1 million ordinary shares in issue for the whole year. Jubilee had a number of exercisable share options. Again, share options are potential ordinary shares, number one. Number two, whenever share options are given, another possible name for the share option is warrants. In case of share option, you are supposed to calculate shares for nil consideration. Only shares for nil consideration will dilute your EPS. Only shares for nil consideration will dilute your EPS. Jubilee had a number of exercisable share option outstanding at the year end. Holders of the option were entitled to buy 50,000 new shares for 1.6. 1.60 is exercise price. The average market price of Jubilee's share for the previous 12 months was $2. Now listen, average price is $2. We are asking them to give us 1.6. How much we are not going to get? 0.4. So in case of share option, we always calculate shares for nil consideration, and only the shares for nil consideration, they will dilute your EPS. Shares for nil consideration. Total number of shares, share option, they are 50. We are not asking 0.4 out of 2. How did I get 0.4? Exercise price is 1.6. Average market value is 2. So 50,000 into 0.4 divided by 2. I'm getting 10,000. Already we have 1 million shares. Okay. Okay. So this becomes your weighted average. Earning, they have given us 1.6 million. So let's see what is diluted EPS. Students, I'm getting 1.58. Again, we have 4 as well. This is also a box question, so we'll go for 2 decimal places. Just a minute. This is the one, 1.58. Question 11. ACCA has correctly calculated basic EPS for the current year. Fine. Which two of the following items need to be additionally considered when calculating? Actually, when we calculate diluted EPS, we actually need to consider potential ordinary shares as well. Basic EPS, they have already calculated. So now they're asking for diluted, what two additional instrument we have to consider. Obviously, those two additional instrument will be potential ordinary share. 145, right? We will not, right is not a potential ordinary share. Logically, the impact of right issue is already there in the basic EPS. So we have already considered. We just need to tell our examiner the name of the two instrument which will be considered additionally for calculating diluted. The issue during their convertible, yes. Convertible bond is a potential ordinary share, and we have to consider this while calculating diluted EPS. The granting during their of director share option exercisable in 3 years, yes. Equity shares issued during their purchase consideration for equity share. You have actually issued the shares to buy a subs to get the control in the new substrate. The impact of point number A and D is already there in the basic EPS. For diluted, additionally, we have to consider the impact of B and C. Now let's see this. This is also from a study hub. It's a section B style question, I would say. Earnings per share, consolidated profit or loss. Okay. Profit before financing, income tax, preference dividend, then preference income, profit before income tax. And now listen carefully. The dividend which examiner has deducted here, logically it is an interest. Why? Actually, you can just see one thing. First, examiner has given us the profit before financing and income tax, and after that examiner says deduct the preference dividend. If examiner is nothing is mentioned, it means this preference dividend is a dividend on redeemable preference shares. And redeemable preference share is your debt, it is our loan, it is a financial liability. And on debt, we pay interest, we don't pay dividend. Even though the dividend is written, it is actually interest. If in the entire question nothing is mentioned regarding this preference dividend, means logically this is the dividend on redeemable preference shares, and dividend on redeemable preference share is an interest. Then income tax, profit for their examiner has given us last year, this year, fine. Equity shares, again, I'm very surprised. Zero disturbance to the students when it comes to weighted average ordinary shares. 1 lakh divided by 0.5, I am getting 200,000 number of shares. Calculate EPS for their December X6 with comparative. Means we have to calculate EPS of the previous year also. So simple. Simply, we'll take 55,300 and 52. Both of them will be divided by 2 lakh. Previous year EPS will work as comparative. So 52,000 divided by 2 lakh. I'm getting 0.26. This is comparative. 55,300 divided by 2 lakh. I'm getting 0.2765. Okay. Now it is part B of this same question. Bonus issue. Consolidated profit and loss in part A. Capital structure is at part A. Except that bonus issue was made in Fab X6. One new bonus share for every 4 shares held. Bonus fraction. Actually, bonus fraction is equal to shares after bonus. Divided by shares before bonus. Can I say before bonus they are 4, after bonus they will be 5? This is bonus fraction. Okay. We are required to calculate EPS of X6 with comparative. Actually, in case of bonus fraction, we have to restate the EPS of previous year. No issue at all. First of all, 2000 X6. Logically, how will you calculate weighted average ordinary shares? Already we have got 2 lakh shares. Simply multiply by the bonus fraction. This, because in case of bonus issue, we assume that bonus were issued at the start of the accounting period. Students, I'm getting 2 lakh 50. Weighted average ordinary shares, they are 2 lakh 50,000. Okay. Earnings, they are 55,300. Basic EPS. $55,300 divided by 2 lakh 50. I'm getting 0.2212. Comparative. Original, we have 0.26. In comparative, you have to show original as well as restated. Now we have to restate this. How do we restate? Whenever there's a bonus issue, simply we restate. How do we restate? You just need to multiply previous year EPS with the inverse of bonus fraction. If there's a right issue, still we have to restate the previous year EPS. If in the question we have got bonus and right both, so we'll be taking fraction of both of them and we will multiply with the inverse of bonus with the inverse fraction of right issue to the previous year EPS to calculate restated EPS. So here comes the restated EPS. 4/5. So while restating, just take inverse of the bonus fraction. I'm getting 0.208 or you can say 0.21. Now see, wow, we have got right issue as well. Looks a good question to me. Calculate EPS X6 with comparative. Oh, no. Something went wrong. I hope not. Not safe. Okay. X6 with comparative. Right issue. Profit. This time they are giving in X5, they are giving us profit how much? 40,050. Equity shares before right 2 lakh. Par value is 1. So number of shares will be 2 lakh also. Because 200,000 divided by par value will give you 2 lakh. October X6, a right issue 1 for 4 at $3 per share was made. Share price on the last day of come right means before right. So student, first of all, we have to calculate theoretical X right price in X6. Part C, I like this part. Shares. Okay. Values and total value. Shares values and total value. Right issue 1 for 4. Share price before right is 3.6 and right price is 3. Let's use the calculator. 4 multiply by 3.6. I'm getting 14.4. So we can say that 4 shares, they have total value how much? 17.4. A 4, oh sorry, 5, 5, my bad, just a minute. Simply 5 shares, they have got total value 17.4. So what will be the value of one share? TERP. Theoretical X right price 17.4 divided by 5. Students, I'm getting 3.48. Calculate adjustment factor. How do we calculate adjustment factor in case of right issue? Share price before right. Share price before right issue. Divided by share price after right issue. Share price after right issue is called TRP, theoretical X right price. Mathematically, the answer is going to be more than 1. Actually, adjustment factor shows the element of the bonus within the right. Complete right is not a bonus issue, but within the right, there is a built-in element of bonus. So that is why you can also use the term bonus fraction for this adjustment factor. And this adjustment factor will apply only on those shares they are there in the question before the right. Adjustment factor is equal to share price before right is 3.6 and share price after the right is 3.48. So this adjustment factor is applicable only on those shares they are there in the question before the right issue. Now come here. 2 lakh ordinary share capital par value 1. So 2 lakh divided by 1 will give us 200,000. Year end is December and right was issued on 1st October after 9 months. So look at this. 200,000 9 upon 12. This adjustment factor is applicable only on those shares they are before the right. Now, how many right shares company is issuing? 200,000. Company has issued one right against 4 shares. So 1 upon 4. Logically, number of rights will be, can I say 50,000? So after right, your total number of shares after right, they will become 250. So last 3 months, your total number of shares will be 250. So right issue, there are 50,000. Before right, total number of shares are 2 lakh. So after right issue, total number of shares will be 2 lakh 50. Let's see the weighted average 2 lakh 9 upon 12 multiplied by 3.6 divided by 3.48. Students, I'm getting 1 lakh 55,172. 2 lakh 50. These are the number of shares after the right issue. 62,500. So here comes the weighted average ordinary shares. 2,17,672. 2000 x 6 basic EPS. Profit is 50,000. Two lakh 17,672. 50 divided by 217,672. Students, I am getting $0.2297, or you can say $23. You can do this also. Okay. You can do this also. A little bit, I would say, rounding off. Now X5, comparative. Comparative. First, original EPS. What was the profit in X5? 40,000. Simply, okay, check. Do we have any preference? No, we don't have any preference. Okay. 40,000 divided by 2 lakh. 40,000 divided by 2 lakh. Students, I'm getting $0.2. Now restate it. How do we restate? Take the previous year EPS and multiply this with the inverse of adjustment factor. 3.48 upon 3.6. So in comparative, you have to show the original as well as restated. Because original is already there. I can't do anything. Technically, restated is the one which we are actually calculating. Students, I'm getting $0.193. Okay. D part of the question, convertible debenture loan note. Now, what is the requirement? Calculate diluted EPS. December X6 with, oh, wow. They're asking us to calculate diluted, but not only for X6, the comparative as well. Okay. They're asking us basic and diluted. Fine. Shares in issue throughout. Throughout is 1 lakh equity shares. This time par value is 0.25. Thank you. Ordinary share capital divided by par value actually gives you the number of shares and they are 4 lakh. Oh, just a minute. Entire 400,000 ordinary shares, they are weighted average shares. Why weighted average? Because it is mentioned in the question shares throughout. So no more issue of shares. Fine. The company issued in X5 $1 lakh 6% loan stock convertible into equity shares on the following alternatives basis. 31st December 2000 Y0 $100 loan stock into 140 shares, then 120. Now listen carefully. Whenever in case of convertible bond, more than one conversion option is available, then always choose the conversion option which gives you the highest number of shares. Why choose the option which gives us the highest number of shares? Because while calculating diluted EPS, the objective is to show the dark side of the business. Diluted means reduce. So obviously where we can issue more shares, then EPS will reduce more. So whenever you have been given more than one conversion option in case of diluted convertible bond, for calculating diluted EPS, you will always choose the option which has the highest, where we can issue the maximum number of shares. So I'll go for the option 1. The market rate of interest of an equivalent loan without the convert. Now this is important. Actually, when we calculate interest expense which goes to the P&L, that we use interest rate relating to the bond which is non-convertible. Actually, it has a link with IAS 32 compound financial instrument, which obviously we are not discussing right now. Right now, the concept is interest expense which goes to the P&L, that will be on the basis of the interest rate which is on the loan which without the conversion option. X5, X6 profit they have given us. Now tax rate is 33%. Okay. So let's first calculate basic EPS, which is I would say very easy. Straightforward is X5. Basic EPS 40,050. Number of shares, they are 4 lakh. Basic EPS. Just a minute. I think 0 point, of course, 1. 50,000 divided by 4 lakh dollars. This is basic EPS. Okay. Now we need to calculate diluted one by one. That's in fact it is same. So first of all, can I say we have to calculate revised PAT, because when we calculate diluted EPS, we assume convertible bond there become ordinary shares in day one. So obviously we will not be paying any interest then. Bond was issued in X, convertible bond was issued in X5. So way to show the working, this is the question. Okay, I'm just dealing here. Okay, let's take this. Existing 40 and 50 if I'm not wrong. Add interest saving after tax. Now student examiner has given us the interest rate relating to the non-convertible bond. So that will be taken. Add interest saving after tax. What was the amount of the bond? 1 lakh. Into 8%, 1 minus tax rate is 0.33. So 8,000 logically multiplied by 0.67, I'm getting 5360. Revised PAT. 45,360, 55,360. Ordinary shares, we already have 4 lakh. Now simply add shares from conversion. Add shares from conversion. Convertible bond is 1 lakh 140 upon 100. 1 lakh 40. Let me repeat, whenever more than one conversion option is given, always go for the highest one. 540. Diluted EPS. Revised profit after tax divided by, you can say, revised weighted average shares. 45,360 divided by 540. Students, I'm getting $0.084. 55,360 divided by 540. I'm getting $0.1025. Okay. Always remember one point. If it really happens, but there's a possibility. If basic EPS is lower and diluted EPS is higher, then this diluted is actually considered as, this is actually then anti-diluted EPS. If you come across a question where your diluted becomes even more than the basic, which is number one, rarely possible, but it is possible only in case of convertible bonds. Why? In case of convertible bonds, basically two events they happened while calculating EPS. One, your numerator also increases due to interest saving after tax, and the denominator also increases. So there's a slight chance that in case of convertible bond, there is a possibility diluted may become more than the basic. If it is, this is the case, then we say it is anti-diluted. But in case of share options, always your EPS will be diluted. In case of share options, anti-diluted cannot come. Okay. Now we need basic and diluted. Last option E. Wow. Shares in issue, again 4 lakh, because share capital divided by par value. Options have been granted to the directors. Okay, we'll come to this one later on. Profit is this. Here comes your basic EPS, straightforward. 50,000 divided by 4 lakh. 50. Dollar 0.125. Options have been granted to the directors and certain senior executive. These give the right to the subscribe for equity share for X6, X9, and 2000Y1 for 0.8 per share. Options were available in respect of 50,000 shares during X6. Average fair value is $1. Again, first we have to calculate shares for nil consideration. Only shares for nil consideration will dilute your EPS. Only shares for nil consideration will dilute your EPS. Let's calculate shares. Just a minute. Shares for nil consideration. 50,000. We are not charging 0.2 out of 1. So I'll get 10,000 if I'm not wrong. Yes. So shares for nil consideration, there are 10,000. So here comes your diluted EPS. 50 divided by 4 lakh 10,000. So 50,000 divided by 4 lakh 10. Students, I'm getting dollar 0.1, you can say 22. Of course, it is diluted EPS. So student, we have discussed all the questions of Study Hub, all the questions which are in the Kaplan kit, we have already discussed. In our regular classes, we have started, I would say IAS 16 as well. So that is all about your EPS from the Study Hub, other IASs, IFRSs, and even the consolidation area from the Study Hub. We will be discussing like this, the way we have discussed today, IAS 33. So I'll be conducting the live revision classes and we'll be discussing the material of the Study Hub. So students, that is all about today's, I would say, first live revision class of this session. So I strongly believe that today's class should have helped you. So hope to see you all in my other classes as well. So thank you very much.